Welcome back to the deep dive. Today, we're looking at a really big move by Keurig Dr Pepper KDP. They're essentially trying to reinvent themselves.
That's right. They're buying JDE Peet. It's a huge deal in itself, but then immediately planning to split the whole thing into two separate focused companies.
Yeah, you'll have Global Coffee Co., Think Stability, and then Beverage Co., which is more about high-growth refreshment drinks.
Exactly. And, KDP has actually done pretty well since it formed back in 2018.
Mm-hmm.
Top-tier CPG performer, really. Think 6% revenue growth, 11% EPS growth annually.
So why the massive shakeup then?
Well, I think they realized that the combined structure was maybe holding both sides back a bit. So our mission today is to unpack this split, figure out the strategy.
And the brands involved, the new financial setup.
Right. And we have to start with the finances because that's where the story got complicated initially.
Okay. Yeah, I remember when the acquisition was first announced, the market reaction wasn't great. Investors seemed worried.
They were. They got spooked, frankly. And the core issue, the vulnerability, was all about debt.
How much debt are we talking about?
Well, the original plan would have put KDP at something like 5.6 times earnings in terms of net leverage by the time the deal closed. That's expected around mid-2026.
Wow, okay. 5.6x leverage. For a company like this, that sounds risky.
It is risky. It signals danger to the market, especially for a business model that partly relies on steady, predictable cash flow. They absolutely had to show they could fund this thing safely.
So they didn't back down, but they went back to the drawing board on financing.
Exactly. They engineered this $7 billion package.
Okay.
They called it masterclass in financial engineering, which, okay, may be a bit much.
Huh, maybe. But $7 billion is serious money. How did they structure it to calm those nerves?
They needed cash that felt more like equity, less like immediate debt burden, and crucially, without hammering the existing shareholders right away. So two main parts.
Okay.
First, $4 billion came from creating a joint venture for the Global Coffee Co.'s pod manufacturing in North America. They sold a minority stake in those assets.
Ah, so they got cash for a piece of the manufacturing but kept control.
Precisely. Retained operational control, majority stake. It smart ties the cash infusion directly to a core valuable asset, not just general borrowing. It's anchored by Apollo and KKR. Big names.
Okay, that's the $4 billion. What about the other $3 billion? That sounded more complex, the convertible perpetual preferred security thing.
Yeah, that's a mouthful, isn't it? But basically, think of it as patient long-term investment capital. Again, Apollo and KKR are involved here too.
Patient capital meaning?
Meaning these big investors put in $3 billion now. They get a preferred dividend, 4.75%, which is pretty reasonable.
Okay.
And then down the road, they have the option, not the obligation, to convert that investment into regular stock, but at a price, $37.25, that was actually higher than the stock price before the acquisition was even announced, like a 6% premium.
I see. So it brings in cash now, keeps debt down, and signals that these major investors believe the Beverage Co. stock will be worth more later.
You got it. It satisfies the debt concerns, and it's a massive vote of confidence in the future value.
And the result of all this financial maneuvering, the so what for the leverage.
The so what is huge. It knocked a full point off that scary leverage number, down from 5.6x to a much more manageable 4.6x expected at the close in mid-2026.
Okay, 4.6x is better. Still needs to come down, though.
Oh, yeah. The plan is clear. Delever by about half a turn each year, get Beverage Co. down to the 3.5x to 4.0x range, and Global Coffee Co. maybe slightly higher, 3.75x to 4.25x. Those are more comfortable long-term targets.
And remarkably, even with all this complex financing, the deal still looks good for earnings.
Yep, still projecting around 10% EPS accretion in year one. That's attractive. Plus, they've built in some flexibility for the future, too.
Like what?
Well, they mentioned potentially selling off other non-core minority stakes later, or even exploring a partial IPO for Beverage Co. If needed, maybe to speed up debt reduction or raise more funds.
So options are open, and the actual separation should be ready by end of 2026.
That's the target. Close the JDE Peet deal first half of 26, be ready to operate as two separate companies by year-end 26.
All right, so they tackled the debt headache. Now let's dig into the why. What are these two companies they're creating? Let's start with Global Coffee Co., GCC. This sounds like the steady Eddie.
It absolutely is. The rationale here is deep conviction in coffee itself. It's a category with really strong structural tailwinds.
Tailwinds like?
Well, think about it. It meets a basic functional need energy, right? But it's also wrapped up in emotion, ritual, even artisanal appeal. people connect with their coffee.
True. And you mentioned something interesting from the source material about health perception.
Yeah, this is a key point. Increasingly, regulators globally seem to view coffee as, well, healthy, or at least not unhealthy like, say, sugary drinks might be perceived. That's a subtle but powerful advantage, a sort of health tailwind.
That's huge, especially considering its history. Coffee seems unshakable.
It really does. Look back 40 years, it's shown a consistent 2% volume growth rate, compound annual growth rate. It powered through the 80s crisis, 9/11, COVID, the recent inflation surge.
People just keep drinking it.
Habitual. Exactly. That reliable, habitual consumption is gold in the CPG world.
So GCC brings together Keurig's North American strength, that's a $4.6 billion business, big D2C presence with Keurig.com too.
Yeah, Keurig.com is actually their fourth largest channel for brewer sales by volume. Significant.
And pairs that with JDE Peet's global footprint. What exactly does JDE Peet's add strategically?
Two main things, really. One is immediate scale in key emerging markets, think Palom, massive brand in Brazil.
Okay.
The other is these incredibly strong, almost fortress-like positions in Europe with iconic local brands. Douwe Geurts in the Netherlands and Belgium, Kenco in the UK, Jacobs, which you mentioned earlier.
Right, #1 in 19 markets.
19 markets across Central and Eastern Europe, dominant. And then there's L'Or in France.
Yes, the L'Or statistic was kind of mind-blowing.
It really is. For the past decade, L'Or hasn't just been the top coffee brand driving growth for French retailers. It's been the #1 brand across all consumer packaged goods.
All of CPG. More than snacks, soda, cleaning supplies.
Everything.
Yep.
That tells you the kind of brand power and loyalty they're acquiring. It's immense.
Meanwhile, Keurig isn't standing still either, right? They're pushing new systems like Alta.
Correct. The Keurig Alta system uses these new K-round pods. They're plastic-free, aluminum-free, designed for both hot and cold barista-style drinks at home. So continued innovation on the Keurig side, too.
And putting these two coffee giants together, they expect cost savings, synergies.
Yeah, about $400 million over 3 years, mostly from streamlining overhead SG&A, IT, that's like half of it. Then procurement savings, maybe 30–35%, and the rest from manufacturing and logistics efficiencies.
Makes sense. So what does the financial picture, the algorithm, look like for this future global coffee co?
It's what you'd expect from a stable giant.
Yeah.
Midterm goal is low single-digit net sales growth. Steady, not spectacular.
But profitable.
Very. Aiming for high single-digit adjusted EPS growth. It's designed to be a cash machine. They're forecasting over $5 billion in cumulative free cash flow just between 2026 and 2028.
Wow. Okay, so GCC is the reliable cash engine. Now let's pivot to the other half, Beverage Co, or BevCo. This sounds like the more dynamic side of the split.
Absolutely. If GCC is stability, BevCo is all about growth, momentum, agility. And it has a strong track record already since 2018. It's delivered about 7.5% net sales growth and almost 12% EBITDA growth annually.
That's pretty impressive growth. What's driving it? Strong brands?
Definitely strong core brands, but also smart expansion and innovation. Take Dr Pepper. It's having a huge moment.
Yeah, I saw it became the #2 soda brand in the U.S.
#2 most consumed soft drink, yeah. Just past Pepsi. And that's after 9 straight years of growing its market share. Campaigns like Fansville seem to be really connecting.
And they're not just sitting on the classics, are they? They seem active in newer categories.
Very active. Look at Canada Dry. Still the #1 ginger ale by far, like 64% share nationally. But they're pushing the Fruit Splash platform hard.
Right. The cherry fruit splash was a big launch.
Huge. #1 CSD innovation in 2024. And they've already announced another flavor coming in 2026. They're keeping the pipeline full.
What about something like Mott's? That feels more traditional.
It is. It's the #1 apple juice and sauce brand. But even there, they see opportunity. They dominate in jars and cups, like 50% share. But in the pouch segment, which is growing fast, they only have about 7% share.
Ah, so there's clear white space for them to grow within their existing brands, too.
Exactly. Aggressively chasing that pouch segment. Plus, they're using partnerships really effectively to jump into fast-growing areas.
Like energy drinks and hydration.
Yep. The partnership with Electrolyte gives them a strong position in the rapid hydration market that's like a $2 billion segment. And the deal with Ghost Energy Drinks continues to pay off, driving significant growth.
So a lot of different brands, different categories. What holds it all together? How do they get all this stuff to market effectively?
That's where their biggest competitive advantage comes in. The direct store delivery network, the DSD system.
Right. That's pretty unique, isn't it?
It's incredibly valuable. There are really only 3 national DSD networks for non-alcoholic beverages in the U.S., and KDP controls one of them. It covers something like 80% of the population.
And having your own delivery system means more control at the store level?
Way more control. Better shelf placement, better stocking, deeper relationships with retailers. It's crucial, especially for impulse buys or fast-moving categories like energy drinks, where being in stock matters hugely.
And they're using tech to make that DSD network even smarter.
They are. They've rolled out this application called Perfect Order. It uses algorithms, analyzing data specific to each store outlet to actually pre-generate the orders for the delivery drivers and sales reps.
So less time counting inventory.
Exactly. Less time counting, more time selling. It improves in-stock rates because the orders are data-driven, and it frees up the sales team to focus on promotions, displays, building relationships, the value-add stuff.
That's smart. Okay, so what's the financial algorithm look like for BevCo, given all this growth and innovation?
It's definitely geared towards growth. Mid-single-digit net sales growth is the target.
Still strong.
Yep. And high single-digit adjusted EPS growth, similar to GCC on the bottom line, but achieved through higher top-line growth. And interestingly, it's expected to generate even more free cash flow than GCC, potentially over $6 billion between 2026 and 2028.
Wow. Okay, so both are set up to be cash powerhouses, just getting there in very different ways.
That's the core idea. Two distinct strategies optimized for two distinct businesses.
Pulling off this kind of massive acquisition and simultaneous split, though, that takes incredible management focus. How do they make sure the day-to-day business doesn't fall apart while all this is happening?
That's a key challenge. They seem very aware of it. They've set up a specific governance structure. There's an executive steering committee overseeing everything, of course.
Standard stuff.
Right. But crucially, they also created a dedicated transformation management office, the TMO. Its sole job is to manage the integration of JDE Peets and the planning for the separation.
So it shields the regular business units.
That's the intent. Keep the base business operations and the local managers focused on hitting their numbers, shielded from the heavy lifting of the corporate restructuring. Let the TMO handle that complexity.
And did we see any proof that this focus is working? Like in recent results?
Actually, yes. The Q3 2025 earnings report came out right in the middle of all this planning, and it was strong. A good proof point.
What did they report?
Well, despite all the talk about inflation pressure, KDP actually raised its full-year outlook for 2025. They bumped up constant currency net sales growth guidance from mid-single digits to high single digits.
Wow, raised guidance during a huge restructuring. That's confident.
It is. And they reaffirmed high single-digit EPS growth for the full year, too. The underlying business was performing well. Refreshment beverages, the future BevCo side, grew sales 14.4%.
Okay, though some of that was the Ghost acquisition, right?
Yeah, with 7.2 points of that 14.4% growth came from Ghost. But still, strong organic growth underneath.
And how did the coffee segment do in Q3, the part getting ready for the split?
U.S. coffee sales were up, but more modestly, 1.5%. That was mostly driven by price increases, about 5.5% net price realization.
Okay, so price drove it, volume was down.
Volume and mix were down about 4.0%. They said that was mainly because retailers were managing their brewer inventories really tightly ahead of the changes. But overall, the fact they could take that much price and still deliver growth while managing this huge transition.
Yeah, suggests the teams are staying focused and executing.
Exactly. It shows they can, walk and chew gum at the same time, even when the walk is incredibly complicated.
Okay, so wrapping this up, the big takeaway for you, the listener, seems to be that this whole KDP transformation, buying JDE Peets and splitting, is really about creating two optimized pure-play companies.
Right. One built for the reliable, steady, almost structural advantages of global coffee co. The other built for the faster-paced, innovation-driven world of refreshment beverages, Beverage Co.
And that whole dramatic financial restructuring we talked about at the start, that was basically the necessary groundwork to launch this dual strategy safely and turn that initial market fear into a clear path forward.
Precisely. They had to fix the funding to unlock the strategy. Maybe here's a final thought, something for you to consider.
Okay.
The source material really emphasizes that coffee's big long-term advantage, maybe its greatest, is that healthy perception, that regulatory tailwind giving it stability. BevCo, on the other hand, thrives by chasing trends, energy, hydration, new flavors, things that can be volatile.
Right.
So the question is, how does BevCo's leadership ensure it consistently delivers that required high growth year after year, decade after decade, especially when compared to the almost recession-proof habitual nature of the coffee business? Can they keep finding the next big thing reliably enough?
That's the strategic tension they've deliberately created, isn't it? Stability versus dynamic growth. It'll be fascinating to watch how both play out.
Absolutely. Two distinct bets on the future of beverages.